Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Richard Saperstein, Founder and Chief Investment Officer of Treasury Partners, a wealth management firm with $8 billion in assets under management. Richard was also ranked 7th on the Barron's list of the top 100 financial advisors in America. Richard, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill.
All right, and let's learn from that 40 years plus experience you have in the markets. What is the biggest issue facing bond investors today?
Well, we're at an historic crossroads for bond investors as the Fed has publicly stated they're going to become more aggressive to fight inflation. And if we look at the last time the Fed pursued an aggressive policy, that was before the great financial crisis. And we had a 10-year Treasury that averaged about 580. In the post-GFC environment, it only averaged about a 240. So investors face the decision of whether or not this aggressive Fed will move rates back up to pre-GFC levels, in which case beware of bonds that are longer term, or will they pursue a more accommodative course of action, in which case we're going to have that lower interest rate environment.
Why should investors embrace active and passive management?
Well, I think there's a misconception between active and passive and the benefits of each. The passive investing captures 100% of the upside and 100% of the downside of whatever index we're pursuing. An active manager, when carefully selected, could pursue something like 90–95% of the ups and only 80 or 85% of the down market. As a result, at Treasury Partners, we combine the two to form a portfolio because in some cases, in rising markets, we want to have the passive investing that'll capture more of the upside. However, in declining markets, we want to have more of the active managers that'll give greater protection on the downside.
You know, Richard, it's so interesting. Over the past couple of years, we've really seen the surge of retail investing, whether it's through Reddit trades or crowd trades or just getting more interested in the market. So my question to you is, why is it important to know and understand what you own?
Well, it's critically important because the environment is changing so dramatically at such a quick pace. And we often see investors with extreme overconcentrations in managers or strategies or sectors. And as the environment changes, they're not keeping up with the change and lightening up or eliminating certain exposures. In addition, now we're in a period where the Fed's going to tighten and it could cause more illiquidity in the market. So investors have to be concerned about whether they have leveraged investments or level 3 holdings within their managers, because they could suffer dramatically in an environment where there's less liquidity. In addition, one of the things we don't see is enough safe assets, because having safe assets or ballast in a portfolio enables investors to reallocate from the safe assets to take advantage of investments that may have gone down in value, let's say the stock market if it declines. So what we want to see is investors with proper diversification and liquidity, as well as some safe assets on the sidelines.
All right, Richard, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
It's my pleasure. Thank you.